So let's move on to markets and investing. And one of the things that you have us here for is to make sure we're watching your money. We're watching the markets, really putting into place strategies that can put you in a much better position. And believe me, we are watching these numbers daily, and really looking at the data to see which way we should be moving. And we will continue to do so for you. So let's go on to the financial speedometers. Again, what we're going to look at first is the credit market conditions. And with these speedometers, they're speed dials per se. The colors are typically going to be red, yellow, green, green being the best, red being the worst. And you've got hands on these. The dotted hand is the previous week's position, and the solid is where we are today. So you can see the credit market is improving. It's gone green this week. Monetary policy has been good all along. So, it is what's driving the credit and the liquidity. So think of it this way. Your liquidity is really the ability to be able to access money if you need it from a company standpoint. And again, that has moved to the positive side as well. And that is largely due to the Federal Reserve's response and our federal government. So not worried about the credit markets at this point. However, saying that, I would say, where's the yield when you're looking at returns relative to income-based portfolios? So if you were used to collecting a check out of your portfolio based on an income bond portfolio, you can really expect that to decrease over time here. And it has actually since 2012, when the secular bear market for bonds had begun. So if you don't need money and you just want the safety, it's fine to be in those positions, but you will not be able to expect the same returns. Now, if you're someone who says, yeah, but I do want the extra income coming in, then at that point, you're going to have to look at shifting the portfolio a little bit tactically to be able to get those returns. So when you're looking at this chart here, it shows you where the returns are going to be coming from, really moving forward, where they are today and moving forward. So you've got U.S. high yield, you've got senior secured loans, which are pretty decent, and you've got emerging markets. Again, each one is going to require a little additional risk, but if you need the money, we'll work it into your risk portfolio to make it work for you. So that's the credit and the bond market. Now let's move on to the financial speedometers. From a financial speedometers, we're going to look at the equity markets and what condition they're in. Well, everybody knows that the stock market just doesn't seem to want to quit. It just keeps moving higher. Now, the last 3 days, we're seeing a different tone, but ultimately, the market has moved up in such a dramatic fashion. No one really expected it to be where it is today. So why is it there? Well, the reality is when you go over to the right side of these indicators, you've got valuation. If you looked at valuation, you'd say, well, wait a minute, that means the stocks are really high, but we're not getting the earnings. And there's where the rub is. Most institutional money managers are still holding money on the sidelines right now because they're concerned that the valuations are really high. That's why this dial is red. When you go all the way over to the left side, you're looking at the fear indicator, which is also red. Now, keep in mind, the fear indicator is a contrary indicator. What's happening is the stock markets and people in the stock market are rather exuberant. Money managers don't like exuberance and very high PE ratios because that can be a recipe for another downturn in the market. So let's take a look at where we are from a price earnings ratio on the S&P 500. So when you're looking at this chart, you've seen it multiple times. What you're seeing that's changing is what the current price earnings ratio is. And it has been inching up ever so rapidly, actually, over the last few weeks. And right now, it's currently at a 22.33. And when you look at that red line at the top going across, you'll see that we haven't been here since 1999. And we certainly understand what happened in 1999 or the subsequent year, 2000, when we had a recession hit at that point. Do we expect the markets to go down as far as it did at that point? No, we don't. But we are expecting a retracement here. So the price earnings ratio is just really on the high side. Most institutional money managers want it in the blue or green zone because that's where they know that they've got a lot of room to run in the rest of their portfolio. So that's where they will be adding the additional funds in the market and getting fully invested. So that brings us to this chart, where we are today. When you look at this chart, you can see that the S&P 500 has really moved up dramatically from where we were in the beginning to where we are today. It's been a steady and rapid increase, but we're kind of hesitating in the market right now. I've talked about this gap over here before. It'll be interesting to see how that unfolds in the future. Again, most indexes, most stocks don't like gaps in the market. They tend to fill them at some point. What could that mean? It could mean that it goes up, hits this number, fills it, and then it comes back down again. Would it surprise me if it started happening during the earnings season, which starts in July? No, that wouldn't surprise me at all. And that's actually one of the catalysts that we're looking at to see where it's actually going to go from there. And again, we'll be watching the data as we're watching the technicals as well. You know, some clients might ask, well, what if it just keeps going up? That could happen. And if that's the case, we've got money on the sideline, we're going to have to get it invested at some point. But we just don't think that's the possibility here. We believe it's going to be retracing, as well as the economists and the institutional money managers we work with. So let's talk about a couple bear markets that we've had in the past. We'll look at October 82 and May of 2009. During that period, after the decline, the market again made a rapid advancement. And many of those looking at it know that the reason that happened was because of policies that were put into place. So when you're looking at this chart, in 82, there was an interest rate reduction policy to get things spurred. In 2009, it was a monetary and fiscal stimulus. Same thing in 2020, what we're going through today, but we're adding reopening an economy to that. The area that I would really like to have you focus on is this right here. When you look at the S&P 500, the next 5 years, the annualized returns, they were 12% and 16% respectively. So we're looking at the market over the next 5 years, once we do get fully opened up, to be rather robust. Maybe not as much as it was over the last two bull markets, but still something that is going to be certainly where we want to be invested, and that would be in the market. If you look at this chart, it indicates where the returns were from a yield standpoint from 2009 to 2019. as well as stocks. And what they're actually forecasting moving forward. And you can see there is certainly a reduction in every area, the stocks, the bonds, and in blend portfolios. And some might look at that and say, well, shoot, that's not quite the return I would like to see. Well, at the end of the day, when we're looking at managing portfolios for clients, we absolutely have to be tactical in these days. It's not to say that there isn't a place for structured portfolios. There is. But if you do not have a tactical component to what you're doing, I think you're going to be left behind. So that is where our focus is. That's where a focus is with our institutional money managers. And when you're looking at the returns, one of the places to boost your return really is alternative investments. Will they be down a bit from 2009 to 2019? Yes, they will, but they're still going to be higher than your typical high dividend stocks, emerging markets, or high yield bonds. So it's a way to get income coming in and boost the yield a little bit at the same time.